Thank you for having me here today. My name is Derek Kwik, and I run a fund called, it's a very interesting name, it's called Brave Soldier Ventures. And I've been doing the venture capital business since the late 90s. I've been around the block quite a few times, and I've seen a lot of interesting stories. And when I was asked to talk about startup failures, we don't have enough time to go through all of them. To start with, I tell you about my background. I was born and raised here, studied in the U.S., and then came back here to work. And when I came back here to work, I started with a large venture capital fund, a prominent one that managed money for the Hong Kong government, Singapore GIC, Docomo, Fujitsu, Mitsui, Sun Microsystems, and at that time a company called Hong Kong Cable and Wireless, which is BCCW. So this goes sort of way back to the first days of the dot-com boom. And at that larger fund, we managed a lot of money, and we basically just invested in all of the dot-com startups, anybody with a business plan, anybody that went to a good school, anybody that worked at a big bank that left, and they got together with their friend who was a lawyer that left, and they started up an internet company. That was the sort of the basic cosmetics of a startup back then. And it didn't matter if the company made any money, we just wanted to invest. So in that, there were just tons of failures. One thing I learned at being at a larger fund is that when you manage that large amount of money, it's okay to invest in companies that fail because you have all the other ones you've invested in to hold you up, hold the fund up. So we spent $250 million US, which at that time was a lot of money. These days it's not much money as a large firm. And we invested in 50 companies. And that was in the span of 24 months. And we sat at a board level, which most funds do. But what I learned from that is that when you sit at a board level and you get your quarterly reports, you get your updates from the founders, by that time, you're really not adding much value because you're not able to provide problem solving. What you're doing is you're actually firefighting, because that problem has been festering for so many months, and founders don't want investors to know that they're not capable of handling certain problems. So they always tone down the issue until it gets too big, too out of control, and then they tell the investors, you know what, we actually have a problem here, we need your help to solve it. And by that time, it's just gotten so big, so out of control, so expensive to fix, and the sales didn't come in, and then the fund actually had to call the loan. And then basically this guy had to go bankrupt. And it was not, it wasn't a good thing, because it was a husband and wife team, and at the end of it, they both split up, and he took the bankruptcy debt, and it wasn't a good situation. So that was the second one. And the third one is on a lighter note, is a Korean company that actually made a really cool game. I think it was called Lineage. Back then, it was a really popular online game. And for us, as an investor sitting in Hong Kong, we actually had to make trips to Korea to visit the company, to sit on the board meetings. But as the ensuing funding rounds went up, and we decided not to continue to invest, we got diluted down, and we became less of a significant investor. And I remember going to these board meetings, and they were held entirely in Korean. All of the financials were all in Korean, and I would raise my hand and say, well, they didn't provide any translators. And I was really upset. I was like, I flew all this way over here, spending all this time, and I have no idea what you guys are talking about. And they kind of pulled up this shareholder paper, and they're like, well, you're just like a really small shareholder, so it doesn't matter. And then they had a vote for something which I didn't know what it was. They were talking about it for a long time. And then I'm like, well, I'm not going to vote because I have no idea what I'm voting for. And they said, well, you're not a very significant shareholder anyway, so your vote's not going to count anyway. So you know what ended the vote being, and it ended up passing, is that this online game developer decided that they wanted to change the whole business model from being an online game developer to an e-commerce company that sold organic vegetables. So those are some bad ones. Well, those are some ugly ones. This one, bad, the good, the bad, and the ugly. This was bad for us because back in year 2000, I was the gatekeeper for the company, for our fund. So because we managed money for the Hong Kong government, we had the responsibility of seeing any company that came in through the website, anybody that came to the office, we had that responsibility to see that company. And what was really interesting about that was that one day in came this guy named Jack Ma. And he had a company called Alibaba. And at that time, I think he had around 25 people in the company. And he was doing his presentation, and I thought, wow, this guy's pretty interesting. But I've seen a lot of companies that were very similar to what he's doing. But I have this feeling about this guy. I think he has the execution capability. So I told Jack, I said, you know what, I like what you got. I'm going to put your deal forward to our investment committee, and we'll see what happens. And you also have to remember that during that time, everything was blowing up. So I went to the committee, which was made up of the partners. And to be fair, they said, you know what, we've seen so many companies like this. How do we know this is the one? And I said, you know, you're right. I don't know, but I just have a feeling that this guy can pull it off. But I think because of all the things that were going on with our other investments, they were a bit gun shy, and they didn't want to pull the trigger on this investment, so they decided not to. And our friends over at SoftBank had put in, I think it was 12 million into the company, and at the peak of its Hong Kong IPO, that $12 million investment was worth over $2 billion. And the partner at SoftBank, his take home, had he cashed out, he didn't, and he was smart not to, would have been $400 million. But he was smart to stay on, and I kind of asked him, his name is Chauncey, I said, Chauncey, why didn't you exit? And he said, well, we think that the companies within the Alibaba umbrella, like Alipay and Taobao, he said, we can spin those out, and those could potentially be even bigger than Alibaba itself. And look at where the company is today. So when I talk about the good and the bad, the ugly, it's not just about the ugly of the mistakes that startups make. It's also the mistakes that investment managers make as well. The good, there are a few of those. One back in year 2000 was phone.com. They invented WAP for mobile, so that's the reason why you can surf mobile on your phone. So surf the internet on your mobile today. And we invested in that company and got in at under $1, and when it listed on NASDAQ, it was over $200. But there's also an ugly story to that too, is that I'm so glad I wasn't a partner at this firm, because that would have been a great home run story to tell everybody, right? But during that time, it was momentum investing. So anything that was $100 today would be $200 tomorrow, and it would just keep going up from there. So we got in at less than $1. It was over $200 on NASDAQ. And then from there, it started to slide. So of course, the partners didn't want to get out at that time. And it went down to 150. And the partner's like, no, it'll go back up. But instead, it went the other direction, kept going all the way down. And kept going further and further down to a point where it was $3. And then the partner's like, okay, let's get out now. Return capital back to investors. You net out your costs. I think we broke even on that one. Not a good story. Ugobi. This was one that was recent as of like a few years ago. These guys made the next generation of the Sony Idol. Remember that robotic dog? you might not know the name of, recognize the name of the founder of the company. His name is Caleb Chung. He is the founder of the Furby, one of the best-selling toys of all time. They sold over 40 million units worldwide. He went into retirement, came out, and had this robotic dinosaur, which is really incredible. It has touch sensors all over its body. It has directional hearing, so if you make a sound, it will swivel its head and look at you. It has a light sensor to the nose. If you turn off the light, it will actually go into battery saving mode, curl up into a ball, and start snoring. And if you make a sound, it will wake up and it'll start walking around again. And it has touch sensors on its feet and an infrared sensor in its nose. So it's always measuring the distance between its head and the surface that it's walking on. So if it's on a table, it will walk to the edge of the table, look over the side, and back up. So it was really, really cool. And this came out in 2006. And in 2006, Time Magazine has this annual digital supplement. And at that time, I think YouTube was on the cover. And Ugobi, this company, got an honorable mention. And so it was a pretty interesting product. This was sort of one of the better stories that we have. I really like this quote: "Everybody has a plan until they get punched in the face." And I think every startup has gone through this, where they have a business plan, but no plan ever goes according to what you had set out for. And this is definitely the case in a lot of the investments that we do, where we think we know it's going to go in a certain direction, but it doesn't. But you have to always be flexible and be able to change with the times and adapt to the situation that you're at. Another good example is, I know we're here to talk about failures, but is a company that we invested in that does mobile payments. And it's a lot like taking the technology, the Octopus card, and putting that into the SIM card, which goes into your phone. All along the way, there were hiccups for this company in terms of getting to commercialization. Right? The thing with financial transactions is particularly a sensitive topic because you're dealing with security, you're dealing with trust issues, and when you go to a mobile operator to sell this technology, you're also dealing with a brand name that's been established. And I find that with technology, when you have a new product or service, no one wants to be the first guinea pig. But if the technology works, everybody wants to be the second guinea pig at the same time. And then you have a scaling issue, you have a resource issue, but it's a good problem to have. So with this company, we kept going out and talking to mobile operators, trying to sell the technology, and all of the mobile operators say, "We love this, but just come back to us after you have your first customer." So that was sort of the issue, but eventually we ended up getting the first customer, which was AIS in Thailand, the largest mobile operator. We turned down an offer from Singtel, who wanted to buy the company, and we wanted to remain platform neutral. So we said we can have you as a customer, but not as an investor. And ultimately, the company now is commercializing with China Mobile. So it's been an interesting story, particularly with the current news on Apple Pay coming up. And I think there's going to be a lot of really interesting things in that space coming up very soon. Safe will never get you to awesome. I think it's really good that you guys, for startup companies, is to always kind of put your neck out there and really push for what you want to do. If you always kind of stay in like your circle of comfort, it's nice, it's comfortable, it's very predictable, it's very routine, but you just never find out how far or the limits of what your company can do or your product or service. So it's very important to sort of always push those boundaries. For me, I like to think of myself as one of the crazy ones where I'm always sort of questioning what can or what can't be done. And I'll end with this last slide, which is life begins at the end of your comfort zone. Don't wait, the time will never be just right. And I think earlier on, someone mentioned that I was a runner, and a bit more than a runner, kind of like a Forrest Gump, where I run across deserts. Starting from the top left, that's the Gobi Desert in China, highest altitude desert. To the right of that is the Sahara Desert, 50 degrees Celsius during the day. Bottom left is the Atacama Desert in Chile, it's the driest. And then Antarctica is on the bottom right. And what does this actually mean is that I like to take on these personal challenges because everything in life is going to be tough, right? And if it wasn't tough, if life was entirely pedestrian, everybody would be doing it, right? So you guys doing your startups, there's always someone's going to tell you it can't be done, or someone's going to doubt you. And yes, you're going to fail, but you have to sort of push past that and get past the point of failure. Every time when I go out and run these, I run one of these every year, and I've done 14 of them now. 2.5 months ago, I was in Madagascar. It's nothing like the movie. Okay. It's much more difficult than that. But I ran 250 kilometers over 7 days, carrying a backpack with all my food and equipment. My feet were a total mess. Hamburger feet. Just really, really horrible. I could hardly walk, but I knew I had to get to the finish line no matter what kind of obstacle was in front of me. And I think that's the same with startups, is you just really have to suck it up. It's painful, it's uncomfortable, but if you really believe in what you're going to do, you'll get there. Thank you.
Well, there must be some questions. Any questions for Derek?
Well, thank you very much for your presentation. I wanted to ask you, when you were first starting out, what was it like when you actually had to set this up? What did it take to sort of launch that idea? And what was that struggle like right at that point, even though later it would be dismantled? But as you got it going, how did it first sort of incubate and come together?
You mean in terms of the first fund that I worked for?
Yes.
Well, I mean, I think you're sort of caught up in the fervor of the .com boom, right? So I think just like with everybody who got into it is you start reading about the news, you start seeing it on TV, reading about the interesting things, the interesting technology companies that are coming up, and you want to be part of that. And I didn't know where in the value chain did I want to be. Did I want to be with a startup, like a lot of my friends did? Did I want to be with a vendor that provided services to a startup? Or did I want to be on the investment side? And I kind of explored the different avenues, and once you found your home within that. So when I joined the fund, I felt like I was with I had a great infrastructure, great support, because the company sort of believed in having multiple offices and hiring all these people with all these brilliant backgrounds. But just like with startups, the company, the focus has to be on execution capability. So when you invest in a startup company, you're not investing in not so much the product or the service. You're investing in the execution capability of the management team, right? You can take a so-so product and you can take a brilliant management team, and they can take that somewhere, right? You can take a really great product and a terrible management team, and that product will go nowhere. So you have that confidence that you have all this support around you, and then slowly but surely you kind of find your niche of what you're good at. And mine ended up being the sort of the gatekeeper of all the business plans and meeting with companies coming in. And of course you have your investment criteria checklist, right? But investing in a company is not about a checklist. It's about actually the psychology of people. And that's something that actually I find that no textbook is going to teach you about, is actually reading human behavior. So when you're listening to a pitch, Actually, I find like business plans that are written, they don't really tell you anything because they're only writing it in a way that they want you to see it. The market opportunity is so many billions of dollars, and we're going to go IPO in 4 years' time, blah, blah, blah. And it's the same story, the same pitch every time. What you really want to focus on is what people how people tell you a story verbally, and how they actually tell it, because there's more than one way to tell a story. I find that's important. And you look at their body language, you look at the way they tell you, look at the things that they focus on, and that actually tells you something about that person. And all the chit-chat before the meeting and the chit-chat after the meeting is equally as important. If they start talking to you about the new car they bought, or where they want to go vacation in the south of France, then you get the impression, okay, this person is materialistic, or so this is where my funding might go if I give it to them. They're not talking about the passion of being in a business. You start to like pick up little things, and it's not so much about the looking at documents that are on the table, but I call it it's all the documentation that's not on the table. And that's where the due diligence comes in, where you reference check. But you're not reference checking documents. Lawyers do that. And the reason why you get the really great companies out there, and why do they fail? You had the best funds investing in these companies. They have the best lawyers looking at all the documentation, yet these companies still fail. Why is that? I think it's because they don't sort of do the due diligence on the other stuff that's more the touchy-feely, where you just kind of have that innate sense about a person. If it smells like shit, it probably is. So if you have that, if something tells you something's not right, then it probably isn't.
Thank you.
It's still related to the idea of pitching and how to kind of like actually impress you as an investor. I guess because you talked a little bit about how the management and the person is really important, but I guess are there any sort of like key elements that you always look for when you see a pitch, that you, I guess, is there a formula for, I guess, even companies or people to kind of follow or use as guidance?
Yeah. So your question is there some sort of structure or methodology to looking at a company? I mean, every fund will have a certain investment criteria that they have, which is a checklist. But I find that when you're listening to a pitch, my job is to poke as many holes into that business model and see if it still holds water. I'm not doing that to have fun. I'm doing that to see how well you know your space. It's like peeling back the layers of an onion. You just keep drilling down, and someone that really knows their area will be able to just keep going deeper and deeper and deeper to a point where I don't even know what they're talking about anymore, right? And that's when you know that this person really knows their stuff. And you really want to provide as many what-if scenarios to see if they've actually thought out how well-rounded their business plan is. So, what if this were to happen? What if that were to happen? You really emphasize this particular area. So this sounds like a core part of your business model. But what if that doesn't work? Have you considered competition? What about if you're talking about technology? What if your technology gets leapfrogged? What kind of how are you going to answer that? Let's say we fund your company, and this situation happens. We're still going to support you, but how are you going to do that? We want to know those types of situations. This is how well thought out is your business plan. And it's never concluded in one meeting. There's always going to be follow-up meetings, and the more follow-up meetings you have with an investor, it really sort of gives good credence to you that the investor is definitely interested. If you have one meeting and you don't hear back from them, or there's not a lot of really good follow-up questions from the investor, that probably means A, they're either too busy, or B, they're not really interested.
Let me go to the
I find your business model very interesting, that you put your team, part of your team in the startup that invest. How do you manage to keep that balance of culture, right? You can have conflicts of interest in terms of
Well, for us, because we're quote unquote early stage investors, our primary responsibility is our own investors, right? So because we're doing high risk investments, it behooves us to put as many checks and balances into the company so that we can protect our investment. Clearly, we want to help the company, but we also have to look at our side as well. So the putting people into the company is our way of providing value, number one, but it's also our way of also having a pulse on the company and getting a feel for the sentiment of what is the camaraderie like? What are the different synergies between different founders? You won't hear about that at a board meeting. You have to actually be on the ground. You have to be with the companies to get that type of feeling. They have to use our finance manager. So if we say we're going to give you $1 billion, we'll drip feed that money in based on milestones. So you hit those milestones, we keep providing you money. But at least this way, if something goes wrong, terribly wrong, and it cannot be rectified, we can hold back on the funding, and then we don't lose out. It's our responsibility to our investors. Because if we lose out, we can't just write it off. We have to explain it to somebody else. Everybody's got a boss, right? So it's our way of doing that. But we're very sensitive not to be involved in areas where we have no knowledge in. So where it works best is if the founder is a technical. So in the example of the mobile payment company, the founder was a college professor in China, and he's an engineer. So he's very much focused on developing his product, but he doesn't have the business acumen to go out and commercialize it. And there's also a language barrier because he didn't speak English. And we said, we have great contact with mobile operators. We'll be your sales and marketing team. You can stay here with your 30 developers and continue to finalize the product. And we put our people in on the sales side to go and help to sell the technology, help to advertise it, help to market it. And we didn't touch anything on the development side because that wasn't where our specialty was. So I don't know if that answers your question, but we really wanted to make sure that we add value, but in the right places.
I'm going to move on, guys. The next challenge is that otherwise everyone is going to be looking at me because we lunch in the panel session.
I'm around, so if anybody wants to.
There you go. So write down your questions and stuff.